All right, let's just jump right in. We all know the names, right? Google, Amazon, Adobe, they're absolute monsters of the market. But what if the story we all think we know about them is just wrong? What if some of the biggest, most famous companies on the planet are actually misunderstood?
It sounds a little crazy, doesn't it? I mean, these are the most analyzed stocks in the world. But that's the big question we're tackling today. Is it possible that the market is so focused on one thing that it's missing these huge, game-changing assets hiding in plain sight?
And that brings us to this key idea, narrative dislocation. It's a fancy term for something pretty simple. It's the gap between the story everyone on TV is telling about a company and what the cold, hard numbers, specifically the cash flow, are actually saying. And for smart investors, that gap, well, that's where the magic happens.
So here's our game plan. We're going to look at the market's blind spots, then dive into some giants fighting false narratives. After that, we'll uncover some hidden value and check out the compounding machines. Then a really cool group, the builders, inspectors, and wildcards. And we'll wrap it all up with a simple investor playbook you can use.
Okay, first up, companies that are in a full-on street fight with a powerful but maybe totally wrong public story. This is where the headlines and the balance sheets are telling two completely different tales.
Let's talk about Uber. For years, the narrative was simple. Uber was a startup that just burned through mountains and mountains of cash. That was the old Uber. But the new Uber? It's a completely different animal. It's profitable, and it's become this absolute powerhouse of free cash flow. And that's the real money a company has left over to grow or return to shareholders. It's a massive sign of health.
And you can see the disconnect right here. A company's PE ratio is basically what the market is willing to pay for its profits. Uber's is sitting around 10.9x, which is what you'd expect for a risky, unproven company. The market is still pricing it like the old cash-burning Uber, completely ignoring that it pulled a brilliant strategic pivot. It turned the threat of robotaxis into an opportunity to become the distribution platform for everyone's robotaxis. It's an incredible story of turning a threat into a strength.
Now, let's look at Adobe. A really powerful and, let's be honest, pretty scary narrative took hold that generative AI was going to kill Adobe's Creative Suite. The fear was that tools like Photoshop would become totally obsolete overnight.
And you know what? That fear had very real consequences. The stock just fell off a cliff. A 32% drop as investors hit the panic button, completely sold on this death by AI story.
But here's the twist. While the stock was getting hammered, the business itself was stronger than ever. Subscription revenue? Record highs. Free cash flow? It had doubled since 2020. The company was so confident, it started a massive share buyback program, which is basically management screaming at the market, "You guys are dead wrong about us."
All right, let's move on to our next group. These are companies where the market sees one thing, but there are these incredibly valuable engines of growth just humming away, hiding in plain sight.
So take Google's parent company Alphabet. This is the picture we all know. Search is king, bringing in 57% of revenue. YouTube ads are another 10%. It's an unbelievable money-making machine. But what if I told you the most valuable parts of Google might not even be on this chart yet?
And here they are. First, Google is one of the only companies building the full AI stack. Think about it like this. They're building the car, the engine, and the fuel, from the custom chips to the AI models to the cloud they run on. Second, and this is huge, is Waymo. While a lot of companies are talking about self-driving cars, Waymo is already on the streets doing millions of paid rides. Some estimates put Waymo's value alone in the tens of billions. And yet, it's basically a rounding error in how the market values Google today.
Now, let's look at Amazon through that same lens. We all think of it as the world's biggest store, but look at this chart. That blue bar on the left is Amazon's free cash flow, and you can see how it just exploded. You know what's driving that? AWS, its cloud computing business. Amazon isn't just a store, it's more like a cloud bank. AWS is a geyser of cash that funds the entire rest of the empire's expansion and innovation.
Okay, next up are the compounders. These are the companies that are just models of consistency, predictable, powerful, and just relentlessly profitable. They're the marathon runners of the market.
A perfect example here is Meta. Now, if you look at its free cash flow on the right, you see that dip, and a lot of people panicked thinking the business was broken. But that dip wasn't weakness, it was a massive investment cycle into AI infrastructure. And the proof is on the left. The core ad business stayed incredibly strong and then snapped right back. It was a sign of a company investing for the future, not a broken business model.
Now, if you want to see the definition of a compounding machine, just look at this chart for ServiceNow. This company basically automates workflow for the world's biggest corporations, and its revenue growth is just beautiful. It's a nearly flawless line that just goes up and to the right year after year after year. It's an investor's dream.
And that incredible revenue growth is matched by its equally impressive and consistent growth in free cash flow. This is the real cash that fuels this future. And ServiceNow is now pouring billions into deploying AI agents to make those corporate workflows even more automated. That should just supercharge its already amazing business.
And of course, you can't talk about compounding without talking about the fortress itself, Berkshire Hathaway. A lot of people see it as this mysterious black box, but it's really just a collection of some of America's absolute best businesses. You get massive insurance operations that collect cash up front and invest it. You get a massive freight railroad that's basically a toll road on the American economy. You get utilities and energy. It's this portfolio of cash-gushing industries that makes it such a reliable long-term machine.
Now for our last group, and this is a really fun one. It's a cross-section of the entire global economy, from the companies literally building the AI revolution to a high-risk, high-reward wildcard. So let's talk about the physical nuts and bolts of our digital world. You've got the builders, like Applied Materials and Lam Research. Think of them as the elite construction crew for the chip industry. They build these unbelievably complex machines that create the microscopic circuits on silicon wafers. Then you have the inspector, KLA Corp. After the builders do their job, KLA comes in with its own machines to scan every single chip for tiny flaws. Because they are the ultimate quality control, they have insane pricing power. Their gross margin is 61.3%. As one analyst put it, that kind of profitability is insulting to every other business on Earth. It just shows you how absolutely critical their job is.
And last but not least, we have our wild card, PDD Holdings, the parent company of the e-commerce app Temu. If this whole portfolio was a dinner plate, PDD would be that spicy little pepper on the side. You know, the one that might give you heartburn, but it's what makes the whole meal memorable.
And this chart of its free cash flow shows you exactly why it's the spicy pepper. The growth is just vertical. But look at how choppy and volatile it is. This is not a steady, predictable compounder. This is a high-drama, high-stakes play in the super chaotic world of Chinese e-commerce. It's a much higher risk for sure, but as you can see, the potential reward is also massive. Okay, so we've looked at all these different giants, from the fortress of Berkshire to the chaos of PDD. What does this all mean for you? How can you actually apply these ideas?
Here's a 4-step playbook. It's pretty simple. First, look for companies that own their entire ecosystem, their full stack, like we saw with Google. Second, always question the popular story, especially when the cash flow is telling you something different, like with Adobe. Third, learn to spot those brilliant strategic pivots, like how Uber turned a threat into its biggest opportunity. And finally, number 4, and this is the most important one, always follow the free cash flow. That's where the truth is.
So I'll leave you with this one final question to chew on. The next time a great company's stock takes a nosedive and the headlines are all screaming, sell, are you going to panic with the crowd? Or are you going to remember this and start looking for the hidden opportunity?